Your bank is lying to you. They tell you a high-yield savings account is safe. But while your money sits there, inflation is eating it alive. If you have $1,000 sitting in a bank, you aren't saving, you're losing. Most people get paralyzed at this exact stage. They see a million options, get overwhelmed, and do nothing. We've stripped away the noise and analyzed the most effective paths for small-scale capital. Today, I'm giving you the $1,000 blueprint. No vague advice. No just buy stocks. I'm giving you 3 specific portfolio allocations: conservative, balanced, and aggressive. Whether you're terrified of risk or ready to go all in, you'll know exactly where to put every single dollar to start building real wealth. Let's dive in. So you've finally done it. You saved your first $1,000. You put it in a high-yield savings account and you feel safe. You think you're winning. But here is the cold, hard truth. Your bank is lying to you. That 4% or 5% interest rate looks great on paper. But then inflation hits. When the cost of living rises faster than your interest, your money isn't growing. It's shrinking. You aren't building wealth, you're just losing it in slow motion. Now you know you need to invest. But this is where the panic sets in. You open YouTube or TikTok and it's a war zone. One guru tells you to go all in on AI stocks. Another says Bitcoin is the only way. Someone else is screaming about index funds. You're paralyzed. You're terrified that one wrong click will wipe out every cent of that hard-earned $1,000. So you do nothing. You leave the money in the bank. This is the analysis paralysis trap. And the cost of this hesitation is a safety tax. Every day you wait is a day you lose out on compound interest. You aren't being cautious. You're being expensive. So you've got $1,000. You're staring at your banking app. You know leaving it in savings is essentially paying the bank to hold your money while inflation eats your purchasing power. But the moment you look at an investment platform, you're hit with a wall of tickers, charts, and jargon. You're paralyzed by choice. Stop guessing. You don't need a finance degree to start. You just need a blueprint. Depending on your risk tolerance, there are 3 specific ways to allocate this money. Let's break them down. First, the conservative blueprint. This is for the sleep well at night investor. You want growth, but the thought of your $1,000 dropping to $800 makes you nauseous. For this, we avoid the gamble. Allocate 40% into a total bond market ETF. That's $400. Put 40% into a dividend appreciation ETF. These are stable companies that pay you just for owning them. That's another $400. The remaining 20%. A broad S&P 500 index fund. It's not a rocket ship, but it's a fortress. It beats the bank and protects your principal. Now, if you're okay with some movement for a better reward, we move to Blueprint 2, the balanced approach. This is the classic growth and stability mix. 70% goes into a total stock market index fund, like VTI. This gives you a piece of nearly every public company in the US. That's $700. The other 30% goes into a diversified bond ETF or a high-yield cash account. This is the sweet spot. You capture the massive upside of the stock market, but you have a $300 cushion to keep you sane during a market dip. Finally, for the bold. Blueprint 3, the aggressive approach. This is for the 25 to 35-year-olds who have time on their side. You aren't worried about a crash today because you're playing the 10-year game. Allocate 80% into a NASDAQ 100 ETF. This bets heavily on big tech and innovation. That's $800. Put 15% into a small cap value fund to find the next giant before it explodes. And the final 5%. That's your moonshot fund. Put $50 into Bitcoin or a high-growth individual stock. Warning, this portfolio will swing. It will be a roller coaster. But historically, this is how real wealth is accelerated. Now, the biggest mistake you can make is overthinking the execution. You don't need to manually trade these. use a brokerage like Vanguard or Fidelity to buy these ETFs. Or, if you want this on complete autopilot, use a robo-advisor like Betterment or Wealthfront. They handle the allocation and the rebalancing for you. The goal isn't to find the perfect stock. The goal is to get your money out of the bank and into the market. Now, the biggest hurdle isn't the strategy. It's the setup. Most people stay paralyzed because they don't know which platform to trust. If you want total control over your ETFs, I recommend Vanguard or Fidelity. But if you want a set it and forget it experience, a robo-advisor like Betterment or Wealthfront is your best bet. I've linked the best options in the description below to save you the research. Here is the reality. That $1,000 in a bank account is losing value to inflation every single day. But in a diversified portfolio, you're finally putting your money to work. In 5 to 10 years, you won't remember the stress of picking a fund, but you will definitely notice the balance. If this blueprint gave you the confidence to start, hit the like button. Subscribe to join a community of people actually building wealth. Now stop saving. Start investing. I'll see you in the next video.